Hi, I'm James Marley, co-founder of Livewire Markets, and welcome to this week's CIO Profile series. I'm joined today by Anton Tagliaferro, one of the most experienced and seasoned fund managers in the Australian market, and also a member of the Fund Managers Hall of Fame. Anton, it's great to have you in and good to see you again.
Good to be here, James.
We bumped into each other at a conference not so long ago, and as we passed each other, you quipped to me that you thought markets were horrible. You said horrible markets right now. What did you mean by that? Why are you feeling that way about markets?
Well, really because there's so much money that's around, so obviously valuations are being pushed up. I mean, we're a value manager, so we like to buy things cheap, and it's hard to identify too many bargains at the moment. I think the other difficulty facing investors at the moment is how short-term news, gets sometimes impacts on different share prices. So I think that's as a result of more quant funds and more computer-type trading, so that it's not unusual to see share prices of individual companies move 5 or 10% in any one day, when really, sometimes not very significant. It's often on not very significant news. So, for example, today the CBA share price is up $2 because they've made some announcement on their quarterly profit. $2 is sort of 2 or 3%. It's quite a big move, because the share price is supposed to represent the cash flows for the next 20 or 30 or 40 years, and really one quarter's earnings is not supposed to move share prices the way it is. So so clearly, all these quant funds, all these whatever, they put it in their system, and all the hedge funds are all short CBA, they're all covering. So it makes it quite challenging, I think, for long-term investors.
Is it just the challenge is for you to be able to distill the message from the noise, or the signal from the noise, so to speak? Is that what you find hard? Is that what the average investor would be finding difficult? Why is the share price moving so much? What's going on? Is that what's complicating it?
Yeah, often, as I said, there's sometimes disproportional movements in the share price on what is not necessarily very significant news.
And what are some of the techniques that you use and the team at IML use to combat that? How do you obviously have to keep investing, that's your job, so how do you push through that? Yeah,
well, obviously, for example, when the CBA was falling heavily, recently on the back of the money laundering scandal or whatever, or allegations, we were buying a lot of CBA, which is good, because often things get oversold as well, so it does present opportunities for long-term investors. Today's share price move again seems like a little bit over the top. So look, it's about buying when that news seems to be overcooked, I suppose, in the share price. And when CBA is running like this, perhaps we might sell some calls on some of our holding to take advantage of the sort of sudden surge back into favour today.
I'd like to take the opportunity to just go back in time a little bit. There's very few fund managers that have been investing in the market for as long as you have. So I'd love to understand a little bit about how things have changed. Mm-hmm. You started in 1986, if I'm correct, not too shortly before the big crash in 87. Can you remember, was there a particular moment or event during those early years that has sort of lasted with you, that sort of helped shape how you invest a little bit?
Oh, look, I think I was fairly young in those days, and you make the normal mistakes, I think, that many investors make when they first go into the market. You listen to sort of tips, and you think it's quite easy to make money on the share market, and then you realise, that as I've said this before in presentations, but the share market is a great place for patient people, for patient investors to make money over the long term, and it can also be a very quick place to lose money if you're trying to make money quickly, and if you're not careful, and if you don't have a certain set of principles that you abide to.
Mm. In 30 years, you must have seen a lot change in terms of technology and innovation. What are some of the constants that haven't changed with investing that obviously allow you to traverse this period where there's a lot of change, the introduction of electronic trading, ETFs, algorithmic trading? What are some of the really enduring things that you think haven't changed with investing? Yeah,
well, I think, at the end of the day, and as you say, there have been many changes, but at the end of the day, if you can buy a good quality stock, and we classify good quality stock as one with competitive advantage, recurring predictable earnings, good management, that has some growth. If you can buy good quality stocks at the right price, as long as the earnings are going up, and the dividends are going up over time, you know, irrelevant of what the market does in the short term or, you know, crashes because of Wall Street or whatever, over time you would expect to do reasonably well from those sort of companies, as long as you buy at the right price.
The start of your presentation at the conference we mentioned earlier, you spent some time looking at the rise of algorithmic and machine trading and passive investing, and I got the impression that you believe that that's a real risk in markets right now. Is that right?
I don't think it's a risk. I think it's changed the way on a day-to-day basis markets are reacting, as I said, sometimes to short-term news. And I think I've made the quote before that you know, today's share market, I don't know what the volume is, 5 or 6 billion, whatever, you know, on every given day. But I would say probably at least half of all the daily activity on the share market is done by people or things who don't understand what they're buying or selling. So in other words, CBA today, it's up $2. Is that long-term fundamental buyers buying today? No, it's probably, you know, hedge funds who are short because of that anti-money laundering scandal a month ago. Quant funds who are suddenly putting in this little upgrade to their earnings, and that's probably what's driving the big jump in CBA today. You know, similarly with the resource sector or the oil stocks, when you get them moving up in the sort of very rapid manner they have in the last few weeks, that's again quant funds or momentum traders or hedge funds using, you know, again, what is a very short-term movement in the oil price, and, you know, it may not be sustainable. It may be back to $50 a barrel in a month, but it's those sort of people, you know, charging in and pushing up Woodside or Origin or Oil Search or Santos, and they don't necessarily know a lot about those companies.
So if that's not, you're not perceiving that as a risk and more of a change to the environment, is there something out there? We've talked in the past about interest rates. You've thought that the level of interest rates is ludicrous. Is there something out there that you perceive as risky, something that concerns you at the moment?
Yes, I think obviously interest rates are having a major bearing on the level of asset prices around the world. And I mean, you know, the reality is, if you look around the world, the US is growing, you know, reasonably well. Europe is recovering. Japan's doing a bit better. China's on track, you know. Australia's not doing too bad. Yet when you look at interest rates in all those countries, you know, there's zero basically in the US, zero in Europe, zero in Japan, and in Australia, you know, they're next to zero, not quite zero, but they're very low. So, you know, you've got interest rates set for a sort of GFC type levels, yet the economies of the world are doing a lot better. So, and that's obviously having repercussions on the valuations of assets, you know, property prices, shares. I mean, at some point, you know, either rates have to go up or else maybe the economy will come off. That's why rates are so low. But it you know, part of the big risk is if any of those settings are changed in future.
As we've alluded to, 3 decades of investing, you've obviously had more good calls than bad calls to have the career that you've had and the success with IML. What are some of the common characteristics that you can think of that have been the attributes of the most successful investments that you've made? What are some of the consistent things that come through when you think about your really successful investments? Yeah,
well, I think number one is to stick to the sort of stocks I talked about, the ones with competitive advantage, recurring earnings, good management, etc. You know, throughout, it doesn't matter what the cycle. I think the other thing, you know, investors have to be very careful is not to chase the momentum, you know, whatever's flavor of the month, because, you know, that may work for a little while, but then, you know, when the direction changes. So, you know, in the tech boom, everyone's chasing techs, and the resource boom, everyone chases resource stocks. But again, you know, that's fine for a while, but then, you know, those types of things don't tend to be sustainable. So I think the one thing I've learned, I suppose, in the last 30 years is always buy today, whatever you'll feel comfortable holding if there's a big change of mood next week. Because that's the one thing I've learned, is that, you know, the mood of the market can change very quickly. No one can predict it, really. Nobody knows, you know, where the index is going to be next week, next month, let alone next year. So basically, you know, if you have a portfolio of stocks, make sure that you're comfortable holding those stocks, you know, make sure you understand why you're holding them. And don't just hold them because, you know, lithium's running or gold's going to suddenly tear away, or, you know, the Nasdaq's going up, so I'm going to hold this tech stock on a P of 90 or whatever. Make sure you understand that, you know, the mood on those sort of things can change very quickly, and you know, you better be comfortable holding those stocks when perhaps some of the wind is out of the sails in those sectors, which can happen very quickly. So I think it always pays to focus on good quality stocks, you know, and I know you miss out on a bit of effervescence and a bit of excitement, but as I said, the mood in the market can change very quickly. So you know, my advice would be to always be comfortable holding what you're holding, understand what you're holding, you know, the shares you're holding, why you're holding them. Is it for yield? Is it for capital growth? Is it to speculate? And it's fun to speculate, but realize if you're speculating, you know, if the mood changes next week, then you know you better perhaps change tack pretty quickly. So yeah, that's I guess the main thing is to always be comfortable, you know, holding what you're holding, and always realize that the market can change, the mood can change, and the direction can change pretty quickly.
One of your 4 rules of inventing, according to a presentation you gave in 2013 that I was able to dig up, was to understand the difference between perception and reality. Reading one of your most recent fund reports, I noticed that IML has said, you know, put some support behind Telstra, or said that you believe that the you know, the dividend, concerns around the dividend are not as well founded as some in the market believe. Can you just talk me through what you think the reality is with Telstra and how it fits into your investment framework, particularly around the quality of management and all that sort of stuff? Yeah,
so look, if you look at the sector, the telecommunications sector, in terms of competitive advantage, you know, Telstra's certainly got a lot of competitive advantage. It's got the scale, you know, the muscle in terms of IT, in terms of spectrum, in terms of new product. You know, it's probably at the forefront of 5G now, etc., and new products, you know, which will come on the NBN, which Telstra's developing. So Telstra's at the forefront of all that. So in terms of the sector, you know, Telstra is at the forefront. In terms of management, they're very conservative. They're pretty good, you know. Again, it's a fast-moving sector. It's got its challenges at the moment because there is more competition, and obviously the NBN is changing the dynamics of the industry, and TPG is building a new network. But again, if you look at Telstra on a individual stock basis, you know, it's got a very good balance sheet. That is one thing that, you know, especially with all the NBN money coming through in the next few years, you know, Telstra's going to have very subdued debt levels, which means Telstra can do share buybacks, or Telstra can look at acquisitions if they become available, you know, so that's, I think, a plus. In terms of the dividend, the 22 cents a share dividend, which they've cut, you know, we thought that was a very overly almost prudent thing to do, given the amount of NBN receipts that they'll be receiving in the next 2 to 3 years. And to us, you know, that level of dividends, and I think Telstra has said this publicly, that level of dividends, you know, Telstra's hoping to grow from that level of dividends in the years to come. So, you know, 22 cents at $3.50, the stock's on a yield of, you know, over 6% fully franked, with a good balance sheet. It's number 1 in the industry. It's building, you know, the new 5G network. So, you know, it's not the best stock in them, and it's cheap. You know, it's on 11 or 12, 13 times. So we quite like Telstra at these levels. Again, we're not going whole as bold as betting the whole portfolio, but certainly as a stock for reliable yield with a good balance sheet, I think it deserves, you know, some positioning in a portfolio that's looking for value in what is, you know, quite an expensive market.
Yeah, interesting. I want to change the subject.
And by the way, we've seen these phases in Telstra before, you know, where people hate it and say it's the end of the world and you know, it doesn't have a future. But, you know, Telstra's evolved as a company. I mean, if you go even back 15, 20 years, Telstra used to make most of its money from fixed line. That started to decline, you know, for many years, and then mobile has taken over. Mobile's probably maturing, but, you know, the fact about the telecommunications sector is that there will be new products and new revenue streams, which I can't tell you today, but there will be, because of our lifestyle and the way things are, that Telstra will participate in future.
And you feel
you're not paying for that.
And they're one of the best positioned to take advantage of that.
Well, they're the best positioned in Australia because, as I said, they've got the best balance sheet. They've got billions of dollars of free cash flow, particularly now that they've cut the dividend. And yeah, they are well positioned to take advantage of any future, you know, new products in the telco industry.
I wanted to change tack a little and talk about your peer group and funds management, and you know, you've obviously seen a lot of fund managers come and go, and I think it's people who are looking at assessing fund managers there's the topic of how do you assess what is the right incentive, and how, when they're choosing a fund manager, how do they make sure the fund manager is aligned with them? You've obviously been able to keep going in your industry for a really long time. I thought I'd ask you, what do you think is the best way for fund managers to be aligned and for them to be incentivised? How do you assess that? How do you run that with your own team?
In terms of, sorry, incentivised in what manner?
The portfolio manager?
Yeah. Well, obviously, if you perform well, people will invest in your fund and they'll keep investing in your fund. If you don't perform well, they won't. So it's very simple in terms of if you want an incentive in the industry.
I'm talking more about the fund managers in terms of, you think just purely by performance, that's what fund managers should be incentivised for?
Well, consistency, obviously. So, I guess every fund manager's got a message, got a style, and we all, talk about we're value managers or we're this or we're that. And I guess the important thing then is to be true to that style. And I think being consistent with that message is very important. I suppose one of the reasons IML has been successful is because, we don't change our message that often. In fact, I often get people coming up at presentations and saying, "Oh, well, I heard you last year, you've just said the same thing, And I say, well, what do you expect me to do? Do you want me to change? Do you want your fund manager to change the story every year, to suit the market? So I think consistency of message. I think, we know where we're trying to position our fund in investors' portfolios, which is hopefully as a low risk type equity fund. So obviously when markets are exuberant like this, we will underperform. But hopefully when you get the, correction, or which is often inevitable in share markets, hopefully our fund will hold up better than most other fund managers.
And just at a personal level, obviously you've been investing for a long time. Are you still finding it passionate, and you still happy to have your hands on the wheels on a regular basis? Yeah,
look, it's challenging sometimes, and sometimes when you're underperforming, as we are at the moment, it does. I get very upset. I don't like not doing well, relative to the market. But as I said, it's about sticking to what you do and waiting for that change. Perhaps a mood in the market when the sort of stocks you're buying, not the high-flying tech stocks and not the high-flying resource stocks or lithium stocks, which we're not investing in, which are all going through the roof. But that won't last forever. I mean, that's now whether it lasts another month, 3 months, 6 months, it's a matter of time until it all comes back to, the PE, how much money the company makes and what sort of dividend it pays, So that's, yeah. So yeah, it's good. As I said, the challenge is finding good value in the current market. But we've had a couple of opportunities lately where we've bought a few things which were, in our view, oversold. Which, as I said, that's one of the things about the current market. Stocks often get slammed down pretty quickly on sometimes what is insignificant news. We talked about CBA, Brambles, which got under $9 because of fears of their US margins. Crown Casino, which got down to the low 11s because of some comment in Parliament, So you do get those occasional opportunities. You just got to be patient and wait for them.
Just as a final point at the stock level, the Myer situation. Can you just give me a bit of an insight as to your views on how that plays out?
Well, look, it's a tough one. Obviously, it hasn't been the best investment of ours. The retail market is tough. Myer's going through transformation. There's a potential predator on the register who's obviously applying pressure and rubbishing them at every opportunity. So, we're hoping obviously the transition that Myer is in the middle of, which is closing the underperforming stores, concentrating on the more profitable stores, changing the way they do business in terms of putting concessions as opposed to home brands. We're hoping, we think that'll work out in the long term. There's a few changes still need to be made. I mean, their online sales are doing better, but there's more they can do there, etc. So look, and Solly Lou's got a 10% holding. He's an aggressive, quite an aggressive shareholder. He's got concerns, which, I wouldn't say Myer's the perfect company. But I think essentially what we'd like to see is, a merger of Myer with Premier, possibly. I mean, that would yield huge synergies to both in terms of, obviously, head office synergies in terms of dealing with landlords in terms of marketing, in terms of, you know, do you have a Peter Alexander in the store or outside the store? That can all be looked at, you know, quite differently. So I think really, at the end of the day, Myer is going to end up either part of Premier or part of the David Jones Group, and that's, I think, how it's going to play out.
Great. Well, Anton, really appreciate you taking the time to come in and share a few of your views. It's always a pleasure to catch up, and we appreciate you taking some time to speak with us.
Pleasure, James. Thanks for asking me.